In this video, we're going to discuss at least the beginning part of bonds and their valuation. We're going to, particularly in the first video here, talk about the characteristics and the bond market itself. So what is a bond? A bond is a loan, right? It's a long-term debt instrument. Essentially, like every other loan, the company gathers money from investors. And in return for that, they make payments in the form of interest. And unlike loans that you might think like a car loan, they don't make monthly payments to the principal, right? If you have a car loan, part of every payment is interest and part of every payment is principal. With a bond, it is an interest-only payment. They pay the coupons annually, sometimes semi-annually, twice a year. But the debt, the amount that they borrowed, is paid at maturity. So it's an interest-only loan with a payment at the end. The par value that I mentioned is the amount that you essentially borrow. We assume that that's always $1,000. The coupon rate, that's the interest that's paid annually or semi-annually. Generally, it's fixed. There are some variable rate bonds, but very, very few. And how you get paid is also you multiply the coupon interest rate, multiply that by the par value, and that's how you get your interest payment. They all have maturity dates. By definition, a bond is typically somewhere after like a 5 years, 5, 10, 15, 20. Corporations can have very, very long maturity dates. There are bonds that have had 50 years, 80 years, 100 years of debt. Now, government bonds are limited to a maximum of 30 years. Issue date is obviously when they were issued, and we have a term called the yield to maturity. The yield to maturity is the interest rate that you earn if you buy a bond today and you hold it to maturity. Sometimes it's referred to as the promised yield. Now, there are some other technical terms we need to get across. The bond indenture is a contract, right? That's what sets out all the rules. So what are the rules? We refer to these as typically standard debt provisions or covenants. So a standard debt provision basically says you have to keep decent books, you have to have general business practices that are sound, right? And obviously you have to make payments. You have to make the coupon payments. Now, restrictive covenants are provisions that are placed on in addition to these standard debt provisions. For instance, if the company is in some trouble financially, they still may want to borrow money, but the lenders might say, we're going to restrict how much money you can pay out in dividends. So you can only pay 30% of your earnings out as dividends. So they'll still make payments, but they're going to restrict it. This will make sure that the company retains enough cash to make payments on the coupons, etc. A security interest would be if there's some kind of collateral pledged. And these are really more specific kinds of bonds when we talk about a secured bond. Now, there is a trustee, and a trustee is typically a corporation. Sometimes it could be an individual, I guess. But they sort of act like a referee, right? They're there to make sure that the company or the government follows the rules that are set out in these guidelines. We have something called a call provision. This allows the issuer to refund the bond issue. Well, what does that mean? It's a fancy way of saying is the government, the corporation wants a way to refinance its debt. If interest rates fall far enough, it becomes economically feasible for the company to refinance their debt, have lower coupon payments, and reduce the overall cost of financing. Now, of course, if they force you to do this, how could they force you to do it? It's in the contract. When you buy a bond, you know whether it's a callable bond or a non-callable bond. Almost all bonds are callable. So again, when you buy one, it sets out the rules. And of course, this is not to the investor's advantage, because when interest rates are falling, now if you need to refinance the money that you get from the call, you're going to get lower cash flows. So bond investors, because this is not a desirable quality, I guess, require higher returns. So they pay higher returns than non-callable bonds. And again, usually this is deferred. And what I mean by deferred means when they issue the debt in the contract, in the indenture, it says for the first 10 years of life, this bond cannot be called. So that means you're going to have it for sure for 10 years. But anytime after the 10th year, you could call, or it could be called. In addition, they can say, look, in the first 5 years, the call premium could be $1,200. And after the 5th year, maybe that declines by $30 a year until it gets to $1,000. But anyhow, the rules and guidelines for when debt can be called or when companies can refinance is set in the contract. So everybody knows what the rules are. There's also something called a sinking fund. And this is a provision where the companies are forced to squirrel away some money. They're going to put some money away every year so that by the time we get to the end of maturity, there's enough money in that account to pay for the mortgage. So this is sort of like amortization on a term loan for like a car. It reduces the risk to the investor, but it also enables the company, it's going to force them to make choices of what to do with this money. Are they just going to put it there and let it sit? Or are they going to use it to pay off the debt when it's to their advantage? So if the bond prices are currently very low, let's say the bond price was $800. The piece of paper has a face of 1,000. So if interest rates are real low, it makes sense to take this sinking fund money, go out to the market, buy the debt for 800 and retire it, thus reducing the debt on the balance sheet by $1,000. So you get rid of 1,000 by paying 800. So obviously, this is an idea here, or a way for the companies to make sure they have enough money to pay off the debt, but also to systematically determine when they're going to buy off this debt. So how would you do this sinking fund? Well, you could just call X% of the issue at par for sinking fund purposes, right? So likely, if the cost of debt is below the coupon rate and the bond sells at a premium, you could just call some of the debt, and that would work just as well as anything else. Or as I mentioned a little bit earlier, you can actually go to the bond market and buy the bond. In case this would be the time when the cost of debt, R sub D here, is greater than the coupon rate. So again, the bond price is going to be fairly low. Some other features and characteristics of bonds, we have things referred to as convertible bonds. These are bonds that you can convert into common stock. Again, when you buy them, you know what they are, and of course, there are rules. There are something called warrants. These are long-term options. Sometimes they're referred to as sweeteners. So if a company's in trouble and they want to issue some debt and the public is hesitant to lend them money, they may attach these warrants to the bond and say, hey, look, if you give us this money today in the form of a bond, later on down the line, you can convert these warrants into shares when we do good things with this money, and you can make some profitability there. There are things called puttable bonds, income bonds, indexed bonds. There are lots of features and different types of bonds, just like anything else. There are characteristics within the contract that can be altered, and different companies will use them at different times. Different types of investors will be interested in different types of features. The last thing to kind of talk about is bond prices. See if I can make this a little bit bigger so we can see it. And here we can see that all bonds are typically sold in $1,000 increments. Now, in the newspaper, this is typically the way you see the bond listed. Here's Verizon. It has a 4.522% coupon. Multiply that by 1,000. Every year they pay $45.22 in coupon. They may do that twice a year. So whatever that is, something like $22.80 roughly, they'll pay that twice a year. It matures in 2048, right, on September 15th. It currently has a yield to maturity of 5.033%. So the price they have listed here is the thing that's a little different, 91.98. This is a percentage of par. So this bond sells for, the trick to this is, if you move the decimal place one place to the right, you have the actual price. $919.80 is what this bond sells for. This bond at the bottom, 104.48. If you wanted to buy this bond in cash, you would need to pay $1,044.80. These bonds that are over 100, we refer to them as selling in the premiums or as premiums. Less than 100 means they're selling at a discount. Doesn't mean they're really good or bad. It just reflects where the price is, either above or below the par value. Thanks for listening to this video. I'll talk to you soon.